Welcome back to The Deep Dive, your shortcut to staying informed. Today we're tackling the Q2 2025 earnings call for Arvinas, that's ticker ARVN. They're a clinical stage biotech, really the leader right now in PROTAC degraders.
Yeah, and this call was pretty critical, I think. It really captures a company at a tricky point. They're trying to move from just the promise of their platform, the whole PROTAC idea, to the much harder reality of getting drugs approved and actually selling them.
And the market definitely picked a side on that equation, didn't it?
Oh, absolutely. The reaction tells you exactly what investors were focused on this quarter. It was pretty immediate.
Okay, so the numbers came out pre-market August 6th. And let's just say the market wasn't thrilled. Let's start with that snapshot.
Well, it's interesting because the financials were a bit of a mixed bag initially. If you just looked at GAAP EPS, the earnings per share, they actually reported a loss of 84 cents.
Right.
Which, beat the consensus. Analysts were expecting something worse, maybe 87 to 94 cents loss per share. So technically an EPS beat.
Usually that gives a stock a bit of a floor, right? Some support.
You'd think so.
Yeah.
But that floor just evaporated instantly because the revenue number was, it was bad.
How bad?
They reported just $22.4 million. The street was looking for something like 31 to 34 million. So a huge miss there.
Wow. Okay.
And yeah, year over year, that's a decline of over 70%, down from 76.5 million in Q2 last year.
70%. Ouch. Okay, so the market signal is pretty clear then.
Unmistakable. Forget the EPS beat. All eyes were on that revenue miss. And just the bigger picture context, shares dropped 15.5% right out of the gate.
Which was what, about $1.18 per share?
Yeah, and on really heavy volume too. 5.43 million shares traded. That's way above their average, maybe 3 times normal. So big money was moving.
So the big question is, how does a company lose 70% of its revenue in a year? I mean, when you dig into it, management explained it, right?
Yeah.
Strategic shifts, some one-time stuff.
They did. Yeah, the explanations make sense fundamentally. But I think the sheer size of that miss just, it spooked people, especially investors hoping for a smoother path towards actually selling something.
Okay, break it down for us. What caused that huge drop?
Right, so that $54 million year-over-year decrease, it mainly came down to 2 things. First, last year's number was boosted by some non-recurring payments, stuff tied to the Novartis license agreement for luxdelutamide.
Ah, the luxdelutamide deal.
Exactly. That deal was basically done and dusted by the end of 2024, so that revenue was always expected to fall off. That's part 1.
And part 2 involves the big Pfizer collaboration, right? Vepdegestrant or VEPD.
Precisely. That's where the strategic drama really lies. They saw about a $6.8 million decrease in revenue connected to that Pfizer VEPD collaboration. And this follows that very public decision back in Q1 to pull 2 really important phase 3 trials from VEPD's development plan.
Okay, so removing those trials, that directly hit the revenue this quarter.
Directly. Because removing those trials, especially the ones looking at first-line and combination use, immediately shrinks the potential market for VEPD. And that triggered this whole need to rework the partnership agreement with Pfizer, leading to less milestone or collaboration revenue right now.
So investors are basically seeing what looked like a potential blockbuster maybe turning into something smaller.
Much smaller, at least in the near term. Yeah, that's the fear.
But okay, amidst all that revenue gloom and partnership uncertainty, management tried to shift the focus, didn't they? They talked a lot about cost control and their financial position.
They did. They highlighted the restructuring they announced last quarter that involved cutting some research programs, deprioritizing things, and a pretty significant workforce reduction, about a third, I think.
Yeah, roughly a third.
And they really emphasized that this achieved a major goal, de-risking the company financially.
You can see that on the expense lines, right? R&D costs down.
Definitely. R&D expenses dropped by about 25 million year over year, down to 68.6 million. And G&A, the general administrative costs, also down about 6 million to 25.3 million. That's pretty disciplined cost management in action.
And the payoff for that restructuring, which they finalized in Q2 with a 7.4 million cash charge?
Yeah, about that.
The big payoff was extending the cash runway. How far out did they push it?
Into the second half of 2028.
Wow. So that's like 3 years of operational runway without needing to raise more cash.
Exactly. And for a clinical stage biotech, that kind of stability, that breathing room, it's huge. It really does de-risk things significantly from a balance sheet perspective.
And speaking of stability and timing, they also touched on the CEO transition. The current CEO is retiring.
Right. And they made a point of saying the search for a new CEO led by independent directors was timed very deliberately. It came after they got the big VEPD data readout, even though it was mixed, and after they secured that extended cash runway.
So getting the house in order before the leadership change.
Pretty much.
Yeah.
And the current CEO is staying on as chair of the board, so there's some continuity there. It felt like a message about managing the transition smoothly and ensuring stability.
Okay, let's pivot then. Away from the financials and the CEO seat and towards the pipeline. Because management keeps saying this is where the real future value is. The story seems to be shifting hard from just talking about the PROTAC platform's potential to actually executing, getting through regulators, and showing clinical differentiation.
Yeah, absolutely. The narrative is all about execution now. And the biggest execution story, the one front and center, is vepdegestrant, VEPD. They're calling it the PROTAC Pioneer.
And they dropped a pretty big piece of news here that maybe got overshadowed by the revenue miss. They submitted the NDA.
That's right. The new drug application for VEPD, specifically for ER-positive, HER2-negative metastatic breast cancer patients with an ESR1 mutation, it's been submitted to the FDA.
That feels historic. The first ever NDA for a PROTAC degrader.
It absolutely is historic. A major milestone for Arvinas and for the whole field of targeted protein degradation. But, and there's always a but in biotech.
Oh.
The efficacy data supporting that NDA, it's a bit nuanced. It comes from the Vertex-2 trial. Now, the good news is they showed a solid 2.9-month improvement in progression-free survival, PFS, specifically in that ESR1 mutant patient group.
Okay, so it worked well for patients with that specific mutation. That sounds positive. Why the market hesitation then, if the NDA is in, isn't that a win?
That's the crux of it. While it worked well in the ESR1 mutant subgroup, the drug did not show a statistically significant benefit in the overall trial population. That's called the intent to treat, or ITT population.
Ah, so the ITT includes everyone in the trial, mutation or not.
Exactly. So the drug seems to work really well for a specific defined group, but not broadly across all the patients tested in that setting. And that has big implications for the potential label the FDA might grant. It likely means a more restricted label just for that ESR1 mutant population.
Which means a smaller initial market than maybe hoped for.
Precisely. And that directly feeds into this whole commercial negotiation, or maybe renegotiation, with Pfizer. Management confirmed they are actively reworking that 50-50 co-commercialization deal.
Because with those bigger phase 3 trials for earlier lines of therapy now gone, the 50-50 split doesn't really make sense for Pfizer anymore.
That's what Arvinas management is saying. The immediate market opportunity for VEPD is now much narrower, basically second-line monotherapy in this ESR1 mutant group. So the economics of the original deal need to change.
And Arvinas sounds prepared for Pfizer to potentially walk away.
They made that very clear. If Pfizer decides to return the rights to VEPD, Arvinas is ready to immediately look for a new partner. But, and this was also very explicit, they are not planning to build their own sales force or fund further big trials for VEPD themselves.
So they're sticking to being a platform and development company, not a commercial infrastructure company.
Exactly. They'll find someone else to handle the commercial side if needed.
Okay, so VEPD has this cloud of commercial uncertainty. Let's shift to the earlier pipeline then. This is where that platform value, maybe less tangled in near-term commercial issues, resides, especially neuroscience.
Yeah, the neuroscience program, ARV-102, targeting LRRK2, is definitely a key differentiator. It's an oral PROTAC, crucially designed to cross the blood-brain barrier, the BBB.
Which is obviously critical for treating brain diseases like Parkinson's.
Absolutely. And the early data, the first in-human results in healthy volunteers, looked promising. They showed it could indeed cross the BBB and actually degrade the target protein in the central nervous system, which they measured in spinal fluid.
So proof of concept for getting into the brain and doing its job. What's next there?
They're moving fast. Dosing has already started in actual Parkinson's disease patients. The single ascending dose part is done. And they expect to have initial data showing pathway engagement in those patients later this year.
Okay, that's a key catalyst to watch.
Definitely. And they're also planning another trial, this one in progressive supranuclear palsy, or PSP, aiming for the first half of 2026. This LRK2 program is really where you see the potential of PROTACs to tackle targets that traditional drugs struggle with.
And that theme of differentiation continues in their early oncology pipeline too, right? Particularly with CRANES.
Oh, yeah. ARV-806, that's their degrader targeting KRAS-Q12D, which just entered phase 1 trials. KRAS, as you know, is one of those notoriously difficult-to-drug proteins driving a lot of nasty cancers.
And the angle here for a degrader versus an inhibitor.
It's all about overcoming resistance. Preclinical data, and it is early data, mind you, suggested ARV-806 can get around the main way tumors fight back against KRAS inhibitors. That involves the tumor rapidly rebuilding or upregulating the KRAS protein.
So the inhibitor blocks it, the tumor makes more faster, the degrader just destroys it.
Essentially, yes. It tags it for destruction faster than the cell can remake it. And again, early days. But the preclinical potency numbers they shared were eye-popping. Something like 25 times more potent than inhibitors, and 40 times more potent than another clinical stage KRAS degrader. The key concept is tackling that resistance mechanism head-on.
Okay, very interesting potential there. And they also highlighted another early oncology asset, ARV-393.
Right, that's a BCL6 degrader. BCL6 is a protein often involved in aggressive non-Hodgkin lymphomas. Again, preclinical data looked good, showing it worked well on its own in lymphoma models.
Any combination potential, that's often key in oncology.
Actually, yes, and it's quite clever. The data suggests it could work well with CD20-targeted drugs like glofitamab. Because, interestingly, degrading BCL6 seems to make the cancer cells express more CD20 on their surface.
So it makes them a better target for the CD20 drug, like painting a bullseye on them.
It's exactly. A smart, potential 1-2 punch strategy there. Okay, so this brings us back to that initial puzzle. We have an EPS beat, cash runway secured out to late 2028, a historic first PROTAC NDA filing, and this promising, differentiated early pipeline. Yet the stock gets hammered 15%. Why the disconnect?
It really boils down to what different people are focusing on. Management, understandably, is pointing to the long-term positives. The NDA milestone, the progress in neuroscience, which validates the platform beyond VEPD, and that crucial cash stability.
But the market?
The market, at least on that day, was laser-focused on the near-term negatives and uncertainties. That big revenue miss, the lingering sort of credibility questions after the mixed VEPD phase 3 results back in March, and crucially, the massive uncertainty around how this Pfizer renegotiation for VEPD will play out.
And broader biotech sentiment hasn't been super helpful either, right?
Not particularly. While the indices like XBI and IBB had a better summer, the market's still very selective. It tends to favor larger companies with clearer near-term revenue over smaller clinical stage stories like Arvinas, especially one navigating this kind of transition. It's just a tougher backdrop.
So for investors trying to navigate this, what are the key things to watch over, say, the next 6 to 12 months? What are the catalysts that could change the narrative?
Okay, near term, you're watching for the FDA's response to the VEPD NDA acceptance for review. Any updates there? Then critically, that ARV-102 data in actual Parkinson's patients later this year, that could be huge for validating the platform in neuroscience.
And the early oncology stuff.
Yeah, you'll want to see initial clinical data starting to emerge from those ARV-806, KRAS, and ARV-393, BCL6 trials. Seeing human data that backs up that preclinical promise would be very significant. Those are the key potential inflection points ahead.
All right, it's time for that segment where we put on our imaginary hedge fund analyst hats and pitch an outrageous but maybe plausible trade idea. And just to be crystal clear, this is purely a thought experiment based on the call. Absolutely not financial advice.
Okay, let's do it. The core thesis here is pretty straightforward. ARVN stock is beaten down, trading near those lows it hit after the disappointing phase 3 data back in March. The market seems to be pricing in almost worst-case scenarios for VEPD and the Pfizer deal.
But crucially, the company isn't running out of money anytime soon. That cash runway into late 2028, plus the actual cash balance, what was it, around $861 million?
Yeah, roughly $861 million in cash and securities. So there's a significant disconnect between the stock price, which reflects maximum uncertainty, and the underlying stability of the balance sheet. The platform value feels heavily discounted right now.
So the outrageous pitch to the investment committee is?
Execute a cash-backed short put strategy.
Okay, explain that. How does selling puts leverage this situation?
So you sell put options, but you specifically sell them deep out of the money, meaning the strike price is significantly lower than where the stock is currently trading. And you choose an expiration date maybe out in early 2026, giving time for some catalyst to play out.
And cash-backed means you actually have the cash set aside to buy the stock if it falls below that low strike price.
Exactly. You're essentially taking advantage of the high implied volatility in the options market because everyone's nervous about the VEPD Pfizer situation to collect a richer premium for selling those puts.
So you get paid up front for agreeing to potentially buy the stock much lower.
Right. You're making a bet that, one, the company's strong cash position provides a fundamental floor, meaning the stock is unlikely to completely collapse below that deep strike price you set. And two, Some kind of resolution on the VEPD partnership, whether it's with Pfizer or a new partner, will likely provide some upside or at least limit the downside from current levels.
So you're exploiting the fear premium in the options market while relying on the balance sheet as a backstop.
Precisely. It's a way to collect potentially significant premium, betting that the platform's underlying value, supported by the cash, is greater than the market's current fear reflects. Even if VEPD ends up being a smaller opportunity than initially hoped, this strategy aims to capture value from the volatility itself, backed by the company's cash reserves.
Okay, stepping back from the trade idea, we've definitely seen the Arvinas story shift, haven't we? It's moved sharply from just talking about the promise of PROTACs to the nitty-gritty of regulatory hurdles and commercial realities, especially with VEPD.
Yeah, the focus is execution. And maybe the real near-term strength now lies in that earlier pipeline, the ability to use the PROTAC mechanism to go after tough targets like KRAS and LRRK2 in ways traditional drugs maybe can't. That's where the differentiation argument is strongest.
But the biggest cloud hanging over everything right now is still VEPD, isn't it? The partnership resolution with Pfizer or finding a new one?
Absolutely. That's the immediate unknown. And tied to that is whether the market will start to give them credit again, re-rate the whole PROTAC platform based on data from ARV-102 in Parkinson's or ARV-806 in KRAS, especially given, the hit to credibility from the mixed VEPD data.
So wrapping this up, what does it all mean for you, the listener? Here's a final thought to chew on. Think about the strategic value of just getting any PROTAC approved. If VEPD gets that FDA nod, becoming the first ever approved PROTAC drug, but the deal with Pfizer means the immediate financial payoff is small.
Right.
Does the sheer validation of the entire PROTAC mechanism itself, proving it can work and get through regulators, potentially outweigh the disappointment around VEPD's specific commercial structure and near-term revenue? That's the really big strategic question you need to think about.